Hey there, everyone, and welcome to the Final Bar. I'm Dave Keller, Chief Market Strategist at Stockcharts.com, not coming from cloudy Redmond, Washington, but a very sunny Silicon Valley, California, here at the Money Show Investment Masters Symposium. Say hello, everybody.
Hello.
Hey.
Everybody.
We're going to recap the market's mixed results for the major averages, the S&P, the Dow, the NASDAQ, all around that zero line. We'll check in on the charts here in just a moment here with our market recap. All right, so looking at the major equity averages here, you can see sort of mixed results, right? End of the day, we really didn't make a lot of directional progress to the upside or the downside. The S&P, the Dow, that is, the S&P, the NASDAQ, all very, very close to Monday's closing level. The S&P finished up about 0.1%. That gets us to around 5188. We'll call it the NASDAQ composite slightly lower, 0.1% lower to 16,332. The Dow, again, sort of flat from yesterday. Now, the Dow earlier, right out of the open, fairly strong, actually came down to test yesterday's low and then popped up a little bit higher. Similar contour to all of the major equity averages, by the way. The mid-cap and small-cap S&P indexes both up about 0.2%. The mega-cap S&P 100, the NASDAQ 100, flat for the day. So if you think about what maybe was not seen today, were mega-caps really thriving and moving to the upside, and those biggest names are such a big weight in our benchmarks. I was giving a presentation earlier here for the at the Investment Masters Symposium for the Money Show in San Francisco. And one of the piece of information I highlighted was the fact that the top 10 stocks in the S&P make up about a third of the weight of the S&P 500 index. The bottom 424 stocks are about the same weight, about a third. So the top 10 and the bottom 424 stocks have the same weight in our major benchmarks in the S&P 500. Talk about an overweight or an over-accentuated weight for the largest names. The VIX slightly lower, not a big change, but still, of course, well below 15. And when you think about the S&P sort of powering out potentially of that bear flag pattern that we've been highlighting recently, the VIX remaining below 15, I think, is certainly one of those main bullet points in the bullish argument because, 2021, extended bull market phase driven by or marked by lower volatility, with the VIX for the most part remaining below 15. We're seeing a similar vibe right now. It also means VIX above 15 would be a big time warning sign. You're really not seeing that yet. Looking at interest rates, you can see the 10-year and 30-year points slightly lower. So the 10-year yield finished today around 446. Long bond yield around 461. The 5-year point around 447. The short end of the curve, as always, I feel like elevated right around 5.25% at the short end. And so overall, we still have that inverted yield curve. Bond prices moved slightly higher. The TLT was up 0.6%. The dollar index up about 0.3%. And that's one of those interesting moves we've seen recently as well. Yields have actually been coming off over the last couple weeks as stock prices have been rallying. And the dollar index really hasn't broken out at all. It's still sort of sideways from where it's been for the last 3 to 6 months. So dollar index, above current levels, the dollar spot dollar index, which on our platform is $USD, that above 107 starts to look like a warning sign, but certainly not seeing that yet. Looking at the commodity space, more red than green. Gold and silver prices both down, along with copper and crude oil prices. Natural gas was a little bit higher, but overall the commodity space sort of flat to down today. Cryptocurrencies, a decent amount of red, but overall hanging in there pretty well. Bitcoin now back above 63K. It got up above 64,000 earlier in the day here, and yesterday's session was actually above 65,000. So we're down a bit from that recent swing high, but overall have bounced off well. We were down in that low 50,000s range. Now we're back to around 63,000. Ether prices holding above 3K, and you can see mixed results for the rest of the crypto space there. Looking at the 11 S&P sectors, here you can see that materials actually did the best, edging out utilities for some of the day. Utilities earlier in the day, certainly utilities were the number one sector. Got beat out just slightly by the materials sector. So materials up 1.2%, utilities up 1.1%, consumer staples up 1.1%, real estate up 1.1%. Now, 3 out of those 4, utes, consumer staples, and real estate, or the three defensive sectors. A lot of people will group healthcare in there. I'm not as much of a fan of that because healthcare is a pretty diverse sector, to be honest with you. But utilities, staples, and real estate are pretty much pure defensive sectors, right? You only own those, generally speaking, when you don't want to own, growthy sectors or cyclical sectors. You want to own defensive sectors, low volatility, things that tend to ride out periods of market uncertainty. So I'm not super bulled up by the fact that some of these defensive sectors continue to be at the top of the list. The XLY consumer discretionary was down the most today, down 0.7%. Technology down about 1/3%. Energy down slightly. The rest of the 11 S&P sectors all in the green. As we mentioned on yesterday's show, on Monday's show, the Keller market model remains bullish on all the time frames. On the main market trend model that I track is this top section. The S&P's now bullish on the short term. Some of these others were negative, and a number of these turned negative in early April on that pullback phase, but now all of them in the green on all time frames. So really reflecting the strength that we've seen here over the last couple of weeks, pushing that short-term model back bullish for me. Look at the mixed results from these magnificent 7 stocks, though. Alphabet and Netflix doing quite well. Alphabet, out of all of these, if I had to pick one that was probably the most constructive, I'd probably go with Alphabet, up 1.9% today. Netflix, number 2, up 1.5%, and Meta up over 0.5%. But look at Tesla down almost another 4%. That's a broken chart and certainly compared to the other names, the other tickers that you see here, very much a negative outlier. But compared to most stocks, it's actually doing quite poorly. Nvidia down another 1.7%. Microsoft down 1% as well. Let's go to a daily chart of the S&P 500 and see how things played out through the course of the trading day. You know, this bear flag pattern that we've been talking about, I would argue, is becoming less and less of a clear bear flag pattern, and arguably, I either have to change the labeling or just admit that it's something different. This tentative bear flag pattern that we laid out was based on the fact that we had that sell-off in the first half of April, got us down to a low the third week in April, and then we have this counter trend move of higher highs and higher lows moving against this larger trend. Now, if and when you break below the lower trend line, and that's key, I would say with any pattern, you have 3 parts, right? You have a setup, which is the chart starts to look like a bear flag pattern, which I think we did probably a week or 2 ago. Then we have the trigger, which is a break below the pattern, which would basically suggest we are in a new downtrend. You know, you could argue got that trigger there. I don't think so. I mean, I think you're still looking for a clear close below that lower boundary. So I would say probably not accomplished yet. And then the third piece you would look for would be follow through or a confirmation, which is the market moves at least a little bit further in the direction of the breakdown. You only got the setup phase here. You didn't get the other 2. And now we're arguably out of the pattern to the upside. I'm still leaving it on here because you could think of this as just a brief breakout above the upper end of the pattern. But overall, this is starting to feel certainly less like a bear flag pattern. And again, until we break below that lower trend line off of the recent lows, you can't call it a bear flag. At best, you're calling it a potential bear flag pattern. So the S&P now back above its 50-day moving average. That actually happened on Monday's session. We had this nice follow through back above the 50-day. Today, moving slightly higher. And I think the real question that I would be asking is, do we make it above the March high? And I think that's a questionable outcome right now. But how much further do you think we go from there? And I would say particularly with the lack of participation of some of those largest names like an NVIDIA, like an Apple, which have really not followed through to the upside after earnings last week. You know, I think questionable that we would have meaningful upside above those previous all-time highs, especially as rates are most likely going to remain higher for longer. Also watch the momentum. The RSI for now is just slightly below 60. You need to break above 60 to sort of confirm a positive momentum layout. We're not really seeing that quite yet. Elsewhere on our Mindful Investor live chart list, we'll look at the Dow theory. Dow theory is a classic look at the S&P and, the original Dow theory, the Dow Industrials and the Dow Transports. I do what I call a modern version of the Dow, Charles Dow's work, looking at an equal-weighted S&P 500 and an equal-weighted NASDAQ 100. The idea of these here is if they're both breaking out, that's bullish. If they're both breaking down, that's bearish. If one is breaking out and the other is not, that's called a non-confirmation. Usually happens at a major reversal point. It's worth noting in March, the equal-weighted S&P made a clear move to a new all-time high in the end of March. The NASDAQ 100 very much did not do so. It wasn't a huge divergence, or it wasn't like it was going down, but it certainly was not breaking to new highs. So maybe that's a non-confirmation there at the March peak. It's not a clear enough one for me to tell you that's an obvious sell signal, but I think what we did observe in April, particularly the first half of April, is both of these undercut their March lows. So even though we've bounced up a little bit, I see this as bearish until and unless these both make it above their March peaks. And if so, I think that is a Dow theory raging buy signal. But until then, I'm skeptical of meaningful further upside beyond current levels. Worth noting, by the way, high yield spreads. We don't look at this chart a lot, but I wanted to note this is a chart that I created a little while ago, just showing the traditional relationship between high yield spreads, or what are called credit spreads, the volatility in this case plotted upside down, and then the S&P. And just a quick comment on this particular layout here, right? The S&P, the high yield spreads in the top plotted upside down. Both of these are actually plotted upside down because they match the direction in the S&P. When spreads are coming in, when these values are getting smaller, that means credit spreads are tightening, and that means that bond investors are seeing more of a risk-on environment. They're not seeing elevated risks out there, and as a result, they're willing to take on a little more risk and take on the risk of high yield or junk bonds of risky companies. So the fact that spreads are the tightest that they've been for the last couple of years, I think is pretty meaningful. There in mid-April, you saw the high yield, the option adjusted spread widen out here. You saw the spreads come up over a 3-week period, but now it's given all of that back, and now back to some of the tighter levels that we've seen. Bearish when spreads widen, because what that means is that bond investors, particularly junk bond investors, are requiring more compensation because they see elevated risk, and they need more compensation to take on this high yield debt. So overall, this is at current more of a bullish configuration. Volatility is coming in as well. The VIX nearing that 13 level, which is a level it hasn't seen since the end of March. The VIX did pop up to around 19 in mid-April. It's now back down to around 13, and that's really more where it was in December, January, February, March. So we're back to a low volatility uptrend kind of environment. VIX above 15 is a warning sign. We're not getting those signs. So high yield spreads are pretty tight. Volatility is coming in. Those two things tend to coincide with stronger equity prices, which is why I've laid out this chart this way. Breadth conditions, as we talked about on Monday's show, we did a segment called Banking on Breadth, and just to reiterate, the long-term breadth conditions have remained fairly strong, and the short-term breadth now improving a little bit more. So really showing that, or illustrating that potential retest of the S&P all-time high around 5250. We'll finish off our market recap here in our adjusted show, and thanks for being patient with us today. Due to my presentation at the Money Show, I had to record this a little later than normal, so thanks for bearing with us, but I wanted to make sure I got some observations to you. Some individual names that are on the earnings list today. Disney reported before the open today. You can see stock gapping lower, and what's interesting is as of Monday's close, we had closed back above the 50-day moving average. Actually looked like a pretty interesting move higher, but note how the RSI never really got above 60. When I mentioned that the stock is moving higher, but the momentum is not in the bullish range yet, in a bearish phase, right, when a trend is down, you'll often find these counter trend moves where the RSI stalled out around 60. Look at Disney in April through October of last year, and you can see what I mean. It's a downtrend phase, and so on those rallies, we don't get overbought. We don't get this nice uptrend. We actually see the RSI stall out around 60, and that's really pretty common with bearish phases. So the fact that we got up to an RSI of right around 60 before today's gap lower just reinforces most likely Disney in a bearish setup. By the way, we closed lower through the course of the day today. So even though we opened around 107, we actually closed down toward 105. So you saw additional selling through the course of the day, which is not a particularly bullish sign for Disney. So Disney down almost 10%, one of the worst performers in the S&P. Squarespace, SQSP, is another company that reported before the open today. Nice move higher, right? Up about 4% today. What's interesting about the chart of Squarespace to me is the fact that these names just exist is encouraging to me, right? Look at this particular level that I'm highlighting. I'm highlighting that resistance from sort of April, May, June of last year. It's kind of in this range. You can see here in December, January, February, we kind of retested this same sort of general area, sort of $33, $34 a share. You can see that as the support that we established just recently. So we had a couple pullbacks to the 50-day moving average, also lining up with that level of support. So reasonable to see that bounce higher off of support. Overall, a chart like Squarespace, I would argue, is bullish until proven otherwise. By the way, it's like Disney flipped upside down. Look how the RSI has held 40 on pullbacks. That's more consistent with a bullish phase. So charts like Squarespace, I think, deserve a second look, regardless of what you think the market environment is. Good stocks, it's always a good time to own good charts, is what I like to say. Lyft reported after the close today. Uber, I think, is before the open tomorrow. So you have however you want to describe these, the car app, the ride app, I guess, ride share app is the word I was going for, companies reporting here. You can see that Lyft actually tested its 50-day moving average from below. It finished the day down about 5.25%. I haven't looked at what it's doing in the after hours session. I don't like to put a lot of weight into the after hours, but certainly going into earnings after the close, not a great setup. And it's a breakdown of the 50-day, testing the 50-day from below. A positive earnings release, you need to get a push back above the 50-day. Then and only then do I think Lyft is worthy of an attention. Nice support here around 1550. So do we hold that on any pullback? If so, that could be a compelling name. One of the gold stocks, by the way, reporting after the close today, Kinross, KGC. We talked about the strength in gold, even though it's been choppy here over the last month, and the GDX and some of the gold plays. KGC is one of those gold stocks, about an $8 billion market cap. And you can see over the last month, we've made new 52-week highs. So can we hold the recent swing lows? Can we hold the 50-day if we get any sort of a disappointing earnings reading? Just to finish off, two other names to talk about. These are reporting before the open on Wednesday, so before tomorrow's open. And both of these stocks are payment processors that have pulled back to their 200-day moving average. Shopify bounced off its 200-day in mid-April, had a couple other tests before getting back above its 50-day moving average this week. Affirm, AFRM, same idea, pulled back to a 200-day moving average, bouncing above the 50-day. If these stocks hold their 50-day through earnings, I think it could be an interesting setup and a potential return to retest those previous all-time highs, but that is a big if. Let's see if it's able to get it done here. Folks, that's a wrap for this show. Thanks so much for joining us every weekday after the close. Thanks for bearing with us this week as we do the show remotely from the Money Show in San Francisco. We'll be back in the studio on Thursday, but until then, be well, stay safe, and have a great one.